Fund Supermart, your online gateway to unit trusts.
Welcome back, ladies and gentlemen. Our next speaker is Mr. Adam Grotzinger, Senior Vice President at Neuberger Berman Asset Management. Adam is a client portfolio manager based in Singapore and serves as the lead representative for the Neuberger Berman fixed income team in Asia. He will be sharing with us today Neuberger Berman's multi-sector fixed income strategy. Adam, please.
Thank you very much. Pleasure to be here this morning, and it's great to see such a big crowd gathering for these discussions on the markets. And I can't think of a better time. Certainly, as we've opened up the book on 2016, it's been, to say the least, a very volatile periods in markets, and markets are trying to digest a lot of ongoing data flow and question marks out there around growth, around central bank policy. So I do want to touch on a number of those factors today and give you our view on some of these key macro variables, and talk about, importantly, in a bond fund, how we're positioning for the layout in 2016 and beyond. Before I go into that, some of you in the room may not be familiar with the firm. I always think outside of just the fund that we're talking about, it's equally important to understand the backbone of the firm that is operating here and the stability of that firm and what we stand for. Our firm in total is managing around $240 billion US dollars in assets under management. We're well diversified in what we're managing. We have a very large equity component of our business that's about $100 billion. We have a debt side of our business that I'm representing that's about $100 billion in size. And we have a growing presence in the alternative space, whether that's hedge funds or liquid alternatives and multi-asset type of solutions. We've been around for a long time. About 75 years ago, the firm was founded by Roy Neuberger. That's the gentleman you see here on the page. And importantly, I think what differentiates us is that we are a private company that is 100% owned by us, the employees. So that gives us a lot of stability in markets that can be volatile, that we can stick with the long-term plan and really ride out kind of some of the volatility that we can see in markets as an asset manager. And that aligns us as well with you, the client. All of our portfolio managers are putting their own money into the funds that we sell to clients and that you invest in with us as partners in these opportunities. So a good alignment with our client base. Now on to the exciting part of the presentation, talking about the debt markets. And what I thought I'd do to kickstart this is, at a high level, just remind everybody here that when we say bonds, that's a general term that I think is used vaguely. We have to recognize that the bond markets are a massive part of the capital markets, one, and that there's very diverse opportunities within the bond markets. You can either be making money in the bond markets, and you can potentially lose money in the bond markets, and that can all happen in the course of 1 year. So what I've charted here is just the performance of different broad market segments of the bond segments of the universe from 2008 up to the end of 2015, year by year. And I think some interesting visuals here to just kind of digest. One, coming out of the financial crisis in 2008, it was pretty common that no matter what you bought in the bond market, you did well. There wasn't really a lot of, let's say, stock selection type of added value to asset managers. Everything made you money. Some made you more than other segments, but all of them put you ahead in terms of your initial capital. What we've seen now over the last couple years, 2 to 3 years playing out, is much more dispersion entering the bond markets. Not only do you have a widening differentials between the top and bottom performing segments, 11.5% in 2013, 6%, 14, 6%, 2015, but you equally have some segments of these markets that have been able to deliver negative returns to investors. So for us as a bond manager in a very flexible bond strategy, our strategic income fund, really what we're looking to do going forward is, one, we expect this volatility to continue and this divergence in bond market fortunes across different sectors to continue, is try to, simply put, separate the winners from the losers. So in my presentation today, I'll go through kind of the segments that we're more optimistic on, where we want to put capital to work, the reasons for that, and the sectors, importantly, that we're avoiding. because when one talks about bonds, there are some segments that look overvalued and look potentially to have capital loss characteristics to them in the years coming forward. The big catalyst out there that I think is going to drive that ongoing dispersion in bond markets and probably even broader asset classes is this narrative of diverging central bank policy as we enter 2016. And what does that mean? Simply put, it means in the US, we've already seen the Fed lift off and raise 25 basis points, and the market's pointing to a continuation of that theme, a tightening of Fed policy as we enter 2016. The market's differing in its views about how much the Fed is going to raise, but the consensus now is, maybe a couple hikes this year. That's a very slow pace for the Fed, but nonetheless a tightening Fed. On the other side of the equation, you have Europe and Japan, large central banks that we expect will continue to ease policy. So you have a very diverging kind of fortunes here between the US gradually tightening what it's done since 2008 in terms of expansionary policy, and in Europe and Japan, largely due to a lack of inflationary pressures and continued easing. That has ramifications for capital flows globally, and that also has ramifications for how different segments of the bond market are going to perform and how you need to think about that. One statistic here that I think is also interesting just to observe is the size of expansion we've seen since the crisis. Really, since 2008, if you look at the Fed has gone from a balance sheet that was roughly $800 billion in size, it sounds large, but to today, $4.5 trillion. So while the Fed is tightening policy, there's still a lot of liquidity out there in the world that's chasing return opportunities. And I think that's one of the large driving factors contributing to this volatility that we're seeing in capital markets today. A lot of cash in the system still, and that cash trying to figure out where the next best opportunity lies. So in the bond markets, what do we want to be wary of? I think in particular, if we talk about the US economy, we would expect to grow at a reasonable pace this year. We call that reasonable pace in numerical terms, probably 2% type of growth. Benign inflation in the US, so we're not looking at excessive inflation picking up. A Fed that is gradually tightening its policy, and interest rates in the US that are likely to rise gradually. So one of the segments of the bond markets where we're more cautious and are actually looking to position from rising bond yields by being short that market is the US Treasury market. In particular, the belly of the curve, which is kind of 5-year duration type of bonds, out to kind of the 10-year bond space. That shows here in terms of the reasons why we want to do that is largely because since the GFC, bond yields have fallen a lot in the US. And now that we're kind of exiting that amount of printing that's been in the system in the US, coupled with reasonable US growth and a tightening Fed, we think the natural inclination for those bond yields is to rise. As bond managers, when bond yields rise, again, prices fall. So we're really looking to be avoiding that segment of the market. That's the US. And importantly in our strategy, what I'd highlight here is that I use the word short. This strategy has a lot of flexibility. So it's not only not owning these bonds, but if we view that yields are going to rise and prices are going to fall, we actually short US Treasury bonds to make money from those yields rising. So that's a more symmetrical return profile that we can benefit in our strategy today. Other segments of the market, Japan and Germany, we're equally short those government bond markets. That's not due to very strong economic fundamentals, but it's more a reflection that valuations in those markets don't reflect the potential for growth in those regions. So for instance, if we think about Europe, German bunds, if you buy a 10-year German bund, Germany, the government of Germany is going to pay you 55 basis points is kind of the average yield that we've seen. We don't think that's attractive. We actually think Europe has more potential to grow in 2016. It surprised to the upside in 2015. And the natural course is that if the economy of Europe is going to grow at 1.5%, 2%, certainly a bond yield that pays you 55 basis points is not a good investment proposition. It's going to be eroded by inflation. So we want to be short the German bond market, and we also want to be short similarly in Japan. due to the very low levels of yield there and the worsening fundamental outlook in terms of the debt stock in the overall Japanese economy. Japan today is running a total debt stock on the government balance sheet that's in excess of 200% of GDP and running a fiscal deficit that is in the region of 8% on an annual basis. We don't think that's sustainable in the long term. In the short term, the domestic Japanese buyers are supporting that market. The BOJ is supporting that market by buying those bonds. But we don't think there's enough return potential there to really be interested in buying those segments. The interesting thing about global bond markets is that this is not our only opportunities. There's actually a number of other sovereign entities that issue debt in the government bond space. And it's some of those markets where we expect continued slowing in growth and yields to come down, where we actually want to be long those government bonds. Examples of that would be New Zealand, who's going through a pretty strong slowdown given the playout in China and given the playout in the broader global economy. Some of the markets in Italy and Spain, we call that peripheral Europe, that are wider in yields than their counterparts in Germany. We think the policy of the ECB, who's going to be printing money in 2016, will continue to support yields in those countries and pressure them downward. So we think that's a good money-making opportunity. And then finally, very selectively, some emerging markets. Not the currency of these emerging markets, but the bond side of those government borrowings. Mexico and South Africa are two examples of government bonds that we like, where we can go in those local bond markets. For instance, in Mexico, buy a 10-year bond and get paid 6 to 7%. We think as well that the Mexican economy will continue to gradually slow, and those bond yields of 6 to 7 should probably come down another 1% or so to reflect the economic realities of those economies as we go through moderating growth in the emerging market world. So that's interest rates, and I call that over here treasuries. If we sum up all those views, that's a government bond view, and we call that a treasury view. We're generally underweight there, but there is room to be overweight and underweight certain markets in the treasury world. Treasuries are not the only thing, though, and back to that first slide of the presentation where I showed the positive and negative returns of different segments of the bond market. Some bond markets actually do well when there's growth, when there's modest inflation, and when the economy is expanding. And a lot of our portfolio today is really focused in the overweight category on those corporate bond segments in the US. If we expect the US to grow at a roughly 2% pace, we expect the Fed to be slow in raising rates, not looking to kill growth. We expect inflation to be relatively benign. That's actually a really good operating environment for many corporates in the US. And particularly, we like what we call the high-yield bond market in the US. These are companies that have a riskier credit profile. They're rated, below investment grade, but actually do better in an economy that is expanding than their investment grade counterparts because they have less sensitivity to interest rates and what the Fed's going to be doing to tighten over the course of the year. High-yield bonds today, in aggregate, that asset class is yielding us 9%. So we think that's a pretty attractive proposition. There's certainly some stresses in the high-yield market, but we think those are isolated to particular areas that are going through turmoil. One of those big areas is the energy sector of the market, and we're very much avoiding that space overall. We like other segments of the market. Telecommunications, for instance, will be one. Healthcare in the US, much stabler type of industry. Gaming in the US, where we have good asset coverage. We think those offer you good return potential relative to future default assumptions, which are very de minimis today, given a growing US economy in the backdrop. An alternative way of playing the strength of the US economy in the bond market and benefiting from that is a technical term. We call it non-agency mortgage-backed securities, but essentially this is residential house loans in the US that are packaged into pools and that you can buy as investors. We like that because many Americans today, once again, have jobs. We've seen unemployment in the US go from 10% down to 5%. American wage growth is starting to lift off gradually. And Americans can once again afford to pay for their mortgages, right? Pay for their home loans. So owning these type of pools of mortgage-backed securities is really a strong proposition for us. One, because they're floating rate instruments, so they don't have a lot of duration sensitivity. And two, because the consumer and the wage growth picture and the job picture is really supportive of that overall tailwind for that segment of the market. A few other segments that we like, senior floating rate bank loans. These are close cousins to high yield bonds. These are actually similar companies to the high yield bond market, but they trade on a LIBOR plus a spread basis. So again, the thematic of not taking a lot of interest rate, owning bonds that are floating rate in nature versus a lot of fixed rate instruments that don't do as well when yields rise. Commercial mortgage-backed securities, again, a close cousin to non-agency mortgages. And finally, selective emerging markets like I talked you through earlier, Mexico, South Africa, countries where we want to benefit from the slowing in growth by owning those government bonds. So that's a lot of moving pieces. Again, this is a global opportunity fund, and I think that's a good thing because it gives us the tool set to navigate different environments. The world's not a homogeneous place, so oftentimes we can find the opportunities to benefit from and ones to avoid in that very large opportunity set. When we pull that all together, the fund looks pretty attractive. Overall, putting all those type of ideas into this portfolio, we're producing a yield today that's about 5.25%. So in a very low interest rate world that we're still in today, we think that's a pretty attractive yield proposition. Actually, what we're committed to in the course of 2016, our payout is actually 4.5%. So we have a little bit of buffer between what we're yielding today and what we're going to be paying out on an annual basis every month. Our duration or our sensitivity to interest rates is equally fairly low. We're not looking to take a lot of interest rate risk. We currently have about 4 years of duration in the portfolio overall, but a lot more of that is corporate bond duration and less so government bond duration. And then finally, a very strong credit rating. The overall average quality of this fund is A-, so that's clearly an investment grade quality fund that pays you a pretty attractive level of yield relative to the low-income world that we continue to be in today. I wanted to talk a little bit about performance because the objectives of this fund, given its broad scope, are twofold. First and foremost, what we want to do is preserve capital. That's our first goal as bond managers, not to lose money for our clients over a cycle. The second thing is to really tee ourselves up for some good return opportunities that look out there in the market 12 to 18 months from now that can be beneficial to positive total return enhancement for the fund. This is just a snapshot of our US registered fund, not the fund that we're selling here in Singapore, but a same strategy, just a different domicile. The Americans buy this, you buy our offshore fund, both are run in the same manner. And that track record's been running for 13 years. And I think pretty impressive is that in the last 13 years, there's been a lot of turmoil in global markets. And that 13 years includes even the global financial crisis that we went through in 2008. And over that 13 years, we've delivered a positive return in 11 out of 12 years out there. Sorry, 12 years in total. And you can see that here. Even in 2008, we had a positive return of 4%, sticking to that capital preservation in a very hard market. 13 plus 0.8. The only negative year we had was actually this recent year, 2015, a very tough year in the markets. We didn't change our positioning, and we continued to be invested for kind of the long-term opportunities that we see that I just talked you through in terms of interest rates and credit sectors that we're positioned in. In the short term, that didn't work out as well for us in 2015. Calendar years are one thing, but I think what a lot of people also think about is what is your performance over different types of periods of performance in the market, not just 2015 or 2016. But thinking about when interest rates rise, how do you do? When interest rates fall, how have you done? During a recessionary period from 08 till the middle of 09, how did your fund do? And during periods of, we took one example of high market volatility that we saw in 2011, how did the fund do? So another way of thinking about the characteristics of this fund, its ability to preserve capital and deliver positive returns. In each one of these scenarios, that fund actually not only outperformed its index, but relative to the index, even when the index was negative, managed to deliver modest positive returns. We're very proud of that characteristic of this fund historically. The overall risk-return profile shown here, we think that's a pretty good balance. This isn't the riskiest fund out there. This is not a dedicated high-yield fund or a dedicated emerging market debt fund. We're trying to build a diverse portfolio that can weather these storms and manage different interest rate or business cycles that we go through. Again, over the last 10 years, this fund has done very well in terms of the overall return. That has been about 7% annualized, relative to the risk, which has ranged between 3% and 5%, but on a 10-year basis is about a 5% volatility. So those are my main talking points really for this strategy. Again, we think this is a great solution for investors looking to protect Capital One, but not compromise their income, still generate an attractive income of about 4.5% per annum. And we think, given the dispersion in the bond markets today, there's a lot of good opportunities that we're investing in over the medium term that will equally be additive to our total returns. So with that, I'll end my presentation and certainly around afterwards for anybody that would like to talk one-on-one about what I discussed here today. Thank you.